Hello traders, welcome to our channel. Institutions have many ways of manipulating price to their favor, and this has been a nightmare to traders who doesn't know or recognize their footprint. But today we bring to you one of our reliable, studied institutional price movements that we have identified, the concept of order block. Marking out an order block isn't just the case, but identifying a high, probably ones that price will respect, neglect, or go against. Stay tuned, because by the end of this video you will know the definition of order block, the psychology behind its formation, how to identify or spot an order block, key element that will make an order block valid to trade and what will disqualify an order block, how to trade them and avoid common mistake that could be costing you money. Plus, I will show you a real-world example so you can apply it immediately. Then what makes order block fail? Finally, a backtest on the setup in different pairs to give you the edge and courage to look for it in your own chart. If that sounds good, please smash that like button. We always appreciate your support, so subscribe if you're new. Hit the notification button so you will not miss out on any of our videos. Let's get started. What is an order block? An order block is an area on the market where a large number of buy or sell orders are clustered. These orders can be from institutional traders, banks, or even individual traders. It can also be seen as a footprint left by institutional traders, banks, hedge funds, and smart money players. Furthermore, massive orders are placed in the zone, causing price to react strongly. Order block usually forms at the end of a consolidation period before a big move. Think of them like launch pads. Price accumulates orders, then explodes in a particular direction, showing that the zone was where the decision was made. And as for that, we zoom in to mark a candle in that zone as an order block after meeting certain criteria. We mark our order block as the last up or down closed candle before moving to the opposite direction. After our backtesting, we notice that there are certain criteria a zone must meet before considering it as a valid order block or tradable order block, because every order block is a demand or supply area, but not all demand or supply area are considered an order block. First of the criteria is a break of structure, or change of character, if the case may be. To start choosing any area as your order block, a break of structure or change of character must be met. Price must break through a recent high or low. Any zone marked or referred to as an order block without a break of structure shouldn't be traded with this concept. Looking at this two candlesticks representation in the first chart, price creates a high and broke it. That's a point to the down close candle that triggered the movement. Unlike the other price action, there is no break of any candle above. This will render any demand zone here an invalid order block. The next criteria are a sweep of liquidity, like sweep a previous candle high for a bearish order block, or low for bullish order block. Liquidity, we know, is the blood life of the market. Price moves seeking liquidity. When an order block takes out liquidity, this means that price reached a level where order have absorbed and take it out. And as the saying goes, the big move happens when most traders are out. An order block that swept liquidity won't be vulnerable for taking as liquidity. Next important is fair value gap. This signals an unfilled order and institutional involvement. On our studies, order block with fair value gap or stand before a fair value gap provide a high probable zone for price to react. We teach this out of years of experience, and we have seen that 70% of most probable order block has an unfilled order. This chart example will illustrate more on this. Consider everything we have said about order block as the last closed candle that took liquidity and broke structure, but there is no imbalance that signals an unfilled order or institutional involvement, so price will likely neglect it or take it out, since there is no big player to defend it. Next example is we see broke structure, and before that, the last opposite closed candle took out liquidity and created a fair value gap. When these criteria are met, then this order block stands a high chance to be respected by price. Moving on, the next example seems valid, but which of this candle will be considered an order block? Wait, let me make it clear. The last candle took out liquidity but couldn't have a fair value gap. Seen this, since the next candle that followed it created a fair value gap. the zone is still valid to trade, but the order block will be considered as a zone, not a candle. Let's see how it plays. Nice delivery. We will cover advanced techniques on how to identify a valid order block. But with these basics, let go into the chart and see how it works. Here on Euro USD 2 hours time frame, we see a price leg that went down and broke a recent lower low with also a major low. That's a clear break of structure showing that the trend is bearish and this will be our protected high. So let's find our possible entry. First, in here price ranged accumulating order and took out this high showing that liquidity have been swept. Next, price displaced with a sharp bearish candle, signaling that this was where the decision that caused this whole movement was made. So we mark out the up-close candle that stood before a fair value gap as our valid order block and consider the rest demand zone as liquidity that will trap early and impatience traders. Let's wait and see how it plays. As you can see, price went to our order block and made a sharp turn, went back again, and form a double top before displacing down, continuing the bearish trend. Always stay patient and wait for the demand that caused the break of structure where the decision was made as not to fall a victim of impatient traders that might like to short from here. Note, order blocks are one-time use. Don't make the mistake of choosing an order block that have been tested by price. Moving to the live chart example. Here on USD JPY, there was clear indication that the trend was heading down, or rather bearish. But it got to this point and started showing sign of exhaustion before sweeping this low and made a big push to the upside, breaking the recent lower high. Such a move is an indication that market is about to change direction. Considering the shift in market structure, we went down, chose the last down close candle before the liquidity sweeps, and adding to the confluence, a clear fair value gap was created. This concept always falls in line with market structure, and it is easy to identify. Let's wait for price and see how it goes. As expected, price went there and moved away, came back retested, broke an internal structure, and came back to the demand that broke structure, and finally took out the recent higher high that was created but still protected, the low of the order block, showing that bigger player is defending that area as a protected low. Always stay flexible with market structure and in choosing an order block, because even after creating a new higher high, price went down and rejected from that same order block area and moved up once again. The psychology behind the formation and validation of order block is institution or big players place large order in the market. And placing such amount of order will draw attention of institutions or other traders out there that might see this and work against them or make them not to achieve their overall target. So instead, they divide this order into multiple positions and start placing the order bit by bit at price, slightly the same, or close to the formal position entry, leaving a trail of break and retest just as you can see here. Don't take my words for it. Go into your chart and look for this same pattern. Train yourself to spot them in every pair and across all time frames. Another live example here, price structure was simple. A sweep below a major low, a break of structure with a clear fair value gap. With this, a soothsayer won't tell you what to do. Mark out your order block and watch price move. You can see for yourself what price did. Take this knowledge and backtest as many times as possible before live executions to avoid losing money. How to play C trade using order block concept. For most traders, making decision on which part of an order block to execute order is always the problem. Whether to go for the beginning of the wick, body, or even 50% of the order block, but we are here to address them. The candle that forms the order block always have upper wick, lower wick, and then the body. Judging from our study, the worst part of an order block to place your order is at the upper wick of a bearish order block and lower wick of a bullish order block, if the case may be. Price won't likely reach at this level because the liquidity that will fuel the movement is likely here, at the body or the early wick, resulting to missed entry. This execution is mostly adapted by traders seeking high risk to reward ratio. Next place you can execute your order using order block is the 50% of order block. You can measure this using your Fibonacci or Gann box in your trading view tools. This is where most of the order have been triggered, so traders believe that this is a mitigation zone where all the possible order have been taken. Moving on, we have the body execution entry. With confidence, this is my advisable order block entry execution, because in fast, high liquidity market movement price will reach here 80% of the time, so I advise you to secure your spot here to avoid missed entry. The last, and again the most promising, is the early wick execution. Once price tap into this zone, some traders take chances and go in. Make your choice and be part of the trade. To recall what we discussed so far, let's take one last live example and an execution. In this 4-hour GBPUSD chart, we can see the price range and sudden displacement to the upside. We mark out our order block, place our entry at the body, stop loss slightly below the swing low, and target the higher high created. Let's see how it plays out. Price retraced and created a new higher high, so we adjust our target. Price went on. This type of trade will test your patience, so stay calm and stick to the concept. Finally, price went to the order block and started the anticipated expansion. With a heart of joy, we reached our target. Always stay patient because market will play its trick on you. Practice and backtest as many times as possible. Be the master of the trend and watch price come to you. Don't forget to subscribe, like, share, and comment topic you wish us to cover next. Thanks for watching.